Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is hedge fund manager, and he also is a senior mining analyst at the Morgan Report, David Morgan's The Morgan Report, and he started a riches and resources website, too, which provides really institutional level valuation analysis for resource stocks. His name is Chris Marchese, and he's the under 30-year-old whiz kid that we've had on multiple times. So thank you for joining us, Chris.
Great to be back.
Now, some of our listeners, I've seen some comments about Chris's interviews and other listeners from other interviews. I just want to address them really quick, Chris, before we get into the interview. This is why our listeners should listen to Chris. He is a self-made multimillionaire. He has worked very hard. He has read hundreds and hundreds of books, and he's put in the hard work to learn all the fundamental analysis and balance sheet stuff he needs to know. He knows more stuff than most of the portfolio managers I talk to have been working in the industry 20 or 30 years. So this is a guy with a good long-term track record. Now, obviously, the gold and silver stocks have had a really rough go of it the last 2 years, but Chris has a really good long-term track record. I've been following Chris's work since after the 2008 market collapse, and he's had a lot of good analysis and predictions with his stock picks. So hopefully our listeners then will learn to respect Chris's views, because as we both know, Chris, in the short term, we can be wrong.
Oh, definitely.
Okay, so Chris, let's jump into the interview here. Before we start talking about the mining industry, let's talk about the supply and demand fundamentals for gold. Now, we've heard a lot of the bearish arguments saying that there is no demand for physical gold because all the portfolio managers are selling off all their GLD. What is your opinion on the real supply-demand fundamentals for the gold market?
I think they're looking great, and they'll continue to improve. A lot of projects have been deferred for later years and canceled altogether. And although that won't show up in the price, this year or next year, it will in maybe 2 or 3 years. There could be a supply deficit. And with China launching 2 ETFs, even though they're small, they'll probably grow very quickly, as it's hard to obtain gold in a lot of parts of mainland China. So it's looking good.
Yeah, Chris, and from what I've seen with the GLD, the bears, the mainstream media, all the shorts, they talk about all this gold that left GLD, and I think there was about 600 tons of it that left, right? But almost all of that gold was bought very, very quickly. It was sold at a premium into Asia or the Middle East. I think the premiums in Asia are still over $30 an ounce for China, and I think the Shanghai Gold Exchange is on pace this year to deliver, to have over 100% of annual world gold mining supply delivered in China. Are those numbers correct?
I'm not sure on the Shanghai numbers. I know they're sitting at around 55 to 60% now, so 100% could very well happen, and probably will happen, especially if we remain at these depressed prices for a couple more months. But yeah, the Asians, the Chinese particularly, recognize the value of gold, and it's a shame Americans don't, and they seem to have forgotten a lot of history in that it's been money for thousands of years. So,
yeah, and
we'll see. This is part of the transfer of wealth to the East, and as China becomes the world's #1 economic superpower.
Yeah, and another thing about demand is India's demand. And you had demand for gold rising so rapidly in India that the Indian central bank has had to try all kinds of schemes to get the Indians to stop buying gold. And then it's causing all these unintended consequences. It's causing gold tourism where Indians are flying into Dubai and buying massive amounts of gold. They're sneaking across the border to Pakistan to buy massive amounts of gold, or they're starting to buy massive amounts of silver.
Yeah, I mean, that's just common sense. If you can't get it, you're going to go through a black market. And for the Indian central bank and government, they don't get to tax all that gold, so they're actually hurting themselves. And their argument is for hiking the import taxes is that it lowers or increases the current account deficit. But so what? It's something of value, something that will hold its value. So, their government is like any other government. They don't know much, and they're actually hurting the economy.
Yeah, I think I saw that up to 500,000 Indians are going to be losing their jobs in the gold industry, in jewelry and other parts of the gold industry in India because of these import taxes. I saw an estimate on that today.
Yeah, I wouldn't be surprised. They've hiked it multiple times, and only since the most recent one has that really curbed gold imports. But that's just because they're going through black markets now.
And knowing the Keynesians and central planners there in India, Chris, they'll probably try another a stimulus program and misallocate hundreds of billions of capital then trying to solve this problem and create even worse stagflation there.
Yeah, it's like every other government, except I think the Chinese are actually a lot smarter than we're giving them credit for. It really is kind of a pet peeve of mine when the mainstream says how bad China's doing. Yet all the people I talk to that travel there and come back say it's not nearly as bad as they're making it out to be. And you got to remember, China's smart. They're obviously not going to report the actual amount of gold they're buying. That would be stupid. You disrupt prices by doing that. They want to buy each ounce at the lowest possible price, and by doing that, you would, report doctored numbers. That's just the smartest thing to do.
Yeah, especially if the Western central banks in the G8 are willing to lease or swap the gold for at artificially low prices. And that's a price now where the miners can't even make money. So let's transition now to our main topic here. This is your expertise, Chris. This is where you make your daily bread. This is where you've had a lot of success in the mining industry you've been doing it since 2008, but that's when I found your work. What is your opinion of the mining industry right now? Can primary gold and silver miners, can they generate free cash flow at these spot prices?
Well, we did a study which we just finished, 2 weeks ago or so, and it was based on Q1 numbers and 2012 numbers for the all-in costs. We define that as, the basic cash costs, extraction, processing, labor, transport, plus G&A, plus interest, plus royalties, plus taxes, plus sustaining capital. And for silver, we took 12 companies. 6 of them were in the lowest quartile in terms of costs on the industry cash curve, or cost curve, sorry. And most of I think 4 out of the other 6 were in the next quartile up. So 10 out of the 12 were in the bottom 50% in terms of costs industry-wide. And we got an average all-in cost of $20.15. And so that leads me to believe that for across the whole industry, the average is probably $22 to $23 an ounce. And some of them are generating free cash flow. The premier silver names, which are pretty well known just because of the size of the silver industry. Your First Majestics, your Silvercrests, your Endeavors, and they're making some free cash flow, but the margins are so much thinner than they were last year and the year before.
And why do you think the margins are so thin?
I think it's, everyone talks about how there's no inflation because they look at the CPI, but, this is a good indicator of actual inflation. Looking at these mining costs, you got to pay for all the metals, all the raw materials, labor, and, energy. And bunch of other things. So those have just been going up, like because of the cost of living's been going up in I would say every country, this year over 2008. These workers are demanding higher wages, and that's leading to higher cash costs because a lot of it's labor costs, especially with mining companies in the U.S. So, it's just a host of things. Everything is, just moving against them. And also, a lot of silver miners have base metal credits to lower their cash costs per ounce. And base metal prices have been moving with silver prices, though they didn't drop nearly as much. They did still drop pretty significantly from the prices at the start of 2012 or 13.
Yeah, and something else about the cash costs there, Chris. Some of these miners have left out a lot of those expenses that you mentioned, like they've left out SG&A, cost of capital, those things in their input costs. When they, put it on a shareholder presentation, obviously their income statements are going to stay otherwise. But the governments, because a lot of these miners are in foreign governments, and the foreign governments see that these gold companies are reporting cash costs of $500 an ounce, and they think that these gold costs are reporting enormous profits, so they're going to jack the royalties up, even though in actuality the gold company didn't report all its all-in costs correctly to the general market, and then the foreign governments are going to take a larger and larger cut, and I think that's been hurting costs too.
Yeah, and just now, there are many, I should say, of silver and gold miners are reporting all-in costs per ounce. But that doesn't take into account sustaining capital for the most part, just because that's a very difficult number to calculate. You got to go back through their PEAs, preliminary economic studies, if they had one for an operation. And that'll outline the life of mine sustaining capital. But these mines, they, for the most part, always are extended in terms of increasing ounces and increasing the mine life. So it just gets very difficult to calculate those costs. So the study that we did just took a really long time, primarily to find those numbers.
And some of the costs, Chris, you talked about, like $23 an ounce for sustaining production costs for the primary silver miners. That doesn't cost that doesn't have the costs in there of them once they pull that ounce of silver out of the ground, going and finding more ounces of silver to replace those. Right? You're looking at a much higher silver price then.
We include exploration costs, but only on those focused on the producing mine or property.
Okay, so once that mine is so if it's an older mine, then the company is going to be looking at a substantial cost increase then.
Yeah.
To go find another deposit.
Yeah, and we exclude capital costs that don't have to do with like sustaining or expansion capital. We don't include that because they're not producing the ounces yet, and the capex spent on constructing a new mine, we don't include that. But if we did, I mean, I wouldn't be surprised to see the lowest quartile of silver miners have all-in costs of 24 to 26 if measured that way.
I see. And speaking of cost of capital, hasn't the cost for a lot of these miners of almost any size, except for the royalty and streaming companies, the cost of them to issue debt and to issue equity, it's gone into penalty rate territory, right?
Debt hasn't been a problem for well-capitalized company, but the cost of equity obviously has, just because all these companies are trading at 5 and 7 year lows.
I see. Well, let's then talk about some hypothetical scenarios here. Now, we both think we've been wrong in the near term. Obviously, we thought gold and silver had bottomed around 15 or 1600, and that was the bottom, and that wasn't the bottom. But if this is not the bottom, Chris, for gold and silver, are there going to be a lot of bankruptcies in the next 12 months? Because you just talked about debt and equity here. The companies are running out of equity to issue in terms of, like, not every company can have an oversubscription like Colossus does. Some of these other gold mining juniors are not going to be able to get their equity at any kind of valuation if prices go lower and lower. What is your expectation here if this is not the bottom? What do you see happening to the industry then?
Well, I definitely think we put in the bottom. I think it was on June 27th, but things can always go lower. And a lot of mining companies are doing the smart thing. Like some are putting their mines on care and maintenance until metal prices improve. And exploration companies, those are just a black hole. They require more cash. So I would expect some of those to go bankrupt. I don't think it'll be near the number that some are projecting. But the higher cash cost producers, maybe those in the highest cost quartile on the cost curve, some of those will definitely go under. And maybe I would guess a quarter of exploration companies, maybe a third.
So you don't think then some of those higher cost producers, you don't think like a Pan American Silver or a Gold Corp or a Yamana Gold will come in with a little bit of cash and buy maybe these guys out for no premium or whatever, just, a merger type thing, not really an acquisition. The management team will do something just to save their own investments and the shareholders?
Well, the companies you mentioned, like Yamana and Gold Corp, they like low-cost operations, so they're not going to go out and buy something that has high costs. They're looking for quality, mines that can be self-sustaining in any price environment. So I don't think that's going to happen. Maybe when prices get a lot higher, assuming they outpace the rise in costs that we've seen.
Yeah, it's a very interesting market right now because I listened to the Sandstorm Gold conference call yesterday, Chris. We were talking about this before we started recording, and Nolan is just sitting on a lot of cash. He's not looking to do any large deals right now, and you kind of see that with a lot of the other large companies that have cash too. No one, except for investors like us, are willing to buy really anything at the bottom. You're not seeing that many mining company CEOs actually willing to go in there and make big purchases. Now, I think you've seen New Gold do one big deal, right? And Yamana bought out Extore about 7 or 8 months ago. But I've only seen really tiny investments from, Agnico Eagle, I think, has put in $5 or $10 million into select near-term juniors that they like that have already advanced their projects far enough. And I think that's all we're seeing right now. Is that right?
Yeah, pretty much. And, it's a smart thing. I think the senior producers, they want to make sure the bottoms are in and their profitabilities are poised to go higher before they want to acquire something. And you got to remember that all these companies like Gold Corp, Kinross, Yamana, Eldorado, they have a lot of things in the pipeline. So those are pretty hefty capital costs. So I think they're doing the smart thing. New Gold made a good acquisition, I thought, by taking out Rainy River, and I think we'll start to see some M&A pick up maybe early next year, mid next year. But until then, I think it'll be one case here and there, one case here or there.
Yeah, I think that's a good analysis, Chris. And I think every, $75 to $100 an ounce gold increase in the gold price that we see, it'll build more confidence for those CEOs to start doing deals, because they don't want to do deals at the bottom. Unfortunately, in this industry, Chris, I don't know how it is in other industries, but studying this industry for many years, and you've studied this industry for years too, it just looks like the CEOs prefer to do deals as the price goes higher and higher. And unfortunately, a lot of these CEOs like doing deals near the tops, the short-term tops of the market.
Yeah, that's the case with a lot of companies like Silver Wheaton, for example. They did that massive deal right before the price of silver just got smashed, and the fundamentals are so good that even when it gets to new nominal highs, relative to the past 2 or 3 years, it's still pretty inexpensive to do it. So that's why I think a lot of CEOs have done it towards the top. And that's why I also think that, a lot of companies don't have that much excess capacity to make acquisitions down here. Going back to when I said that they have a lot of projects that need pretty significant capital investment.
Okay, Chris. Now, let's wrap up the interview here with some asset allocation ideas. What part of the gold and silver industry then do you think is the safest right now? What types of companies? Is it just the royalty and streaming companies? Do you think they're the safest, or do you think the large cap primary miners are just as safe? Or what's your opinion on where the companies that are going to actually survive this correction and will succeed when we do have a turn in the cycle?
It depends on everyone's risk profile. If they were fairly conservative, what I would do is recommend say 30 to 40% spread out, in 3 or 4 royalty companies, another 30 or 40% spread out in, the best mid-tier and senior producers like your Gold Corps, your New Golds, your First Majestics, your Endeavors, and then the rest, keep some cash because that's always good. Things can go lower. And then, however much money you want to put in towards, risk, a little riskier, but still relatively safe investments that should yield a higher rate of return would be investing in, say, like Silvercrest, for example, or basically the lowest cost producers in the industry. And most of those are juniors because the seniors have, a lot of sustaining capital needs. Their mines are so large that, that's required. So we found that, it's actually a lot of junior companies, junior producers and small mid-tiers that have the lowest all-in costs.
And another thing about the seniors, Chris, if I could add to your point there, a lot of the seniors are run in a very bureaucratic way. There tends to be a lot of excess, a lot of wasted money spent. These junior producers and mid-tier producers, the owners of the company builder tends to still be there in a lot of cases, and they tend to have a lot of larger equity stake in the company, so their interests are aligned with the shareholder interests, which normally means that they're going to run the company more efficiently, right?
Yeah, definitely. But, that gets really hard to tell when you're, say, dealing with Gold Corp or Barrick, just because 1% ownership in that company is an awful lot. It's worth an awful lot. So, it's worth checking out more in the mid-tier companies and the junior producers.
Yeah, but with the thing about Barrick, you mentioned the ownership, Chris, but the thing about Barrick is run by these professional manager, operator types, people who came out of business school or something like that, and it's not just in the gold industry, but it's a lot of industries in general. These guys tend to not hit earnings targets. They tend to underperform all the time, and then they give themselves large salaries and stock options anyway. And I think that's why Burack CEO was fired, right? Because he was still getting such large earnings and options packages.
Yeah, that's right. But I've seen the Q2 results that I've seen really point to all these mining companies really trying to trim needless costs like G&A and exploration costs, unnecessary capital investment. And, I think they've done a good job. Even Burack, they had that write down, but, that doesn't affect cash flow. And they generated more cash flow in Q2 than Q1, even with lower gold prices.
Okay, well that's good, Chris. Hopefully these companies will be run a lot leaner and meaner, and the companies that were run inefficiently, they'll either go bankrupt and their assets will be taken over by someone who can run it, or we'll see a merger and acquisitions where the more efficient company will come in and buy up these assets for pennies and then run the mines more efficiently. In wrapping up the interview, though, please tell our listeners more about your work, where they can find it, and the different websites that you have.
The main website is David Morgan's website, silver-investor.com, and our research site is richesinresources.com. We've slowed down adding to that recently just because we have tons of other things going on, but we'll get back to that, and there's already a lot of stuff on there, so...
Yeah, and you're also managing money now too, right, Chris? At a hedge fund, right? Again.
Yeah, with David. So.
Okay, well, very good. Just want to thank you for your time, Chris, and hopefully we'll have you on again soon. And we really, myself and our listeners, really appreciate your insights into the gold and silver industry.
All right, great, thanks.